IAS 12 Video 4. This video is the first video for Lecture 3, and in this video we will be looking at deferred tax, specifically the objective scope, some of the definitions, as well as the formulas for calculating the tax base of assets and liabilities. Please follow along in your standard. What we will be covering in this video, you will find in the objective paragraph and then in paragraphs 1 to 11. So the IAS 12 objective is to prescribe the accounting treatment for income taxes. Now, the objective tells us that the principal issue in accounting for income taxes is how to account for the current and future tax consequences of the future recovery of the carrying amount of an asset or the future settlement of the carrying amount of a liability, as well as any other transactions and other events of the current period that are recognized in the financial statements. So these future tax consequences is what we are accounting for using deferred tax. So we have already done the current tax. Now when we look at future tax consequences, that will be the deferred tax. Okay, the definitions we find in paragraph 5. The definitions that we will specifically look at are as follows. Firstly, deferred tax liabilities is defined as the amount of income taxes payable in future periods in respect of taxable temporary differences. So if we have temporary differences that will in future be taxable, that is going to result in us paying more tax in future. We will have to create deferred tax liabilities. Now, similarly, the definition of deferred tax asset is these are the amounts of income taxes recoverable in future periods in respect of, firstly, deductible temporary differences. So if we have temporary differences that will in future be deductible, that means we will create a deferred tax asset for these temporary differences. Now, we can also have deferred tax assets resulting from the carry forward of unused tax losses, which we will be looking at later, and then also from the carry forward of unused tax credits. However, this falls outside the scope for FRK 300. Next definition is the definition of a tax expense. So it tells us that it's the aggregate amount included in the determination of profit or loss for the period in respect of current and deferred tax. Okay. So this we already know from what we have seen of our income tax expense note. What we did in lecture 1 is we looked at, we know about our current tax for the current year, as well as any over or under provisions that might affect this income tax expense line item. And then in lecture 1, we also looked at foreign tax. Now we also have deferred tax that will affect this income tax expense line. So firstly, the origination and reversal of temporary differences is what we are looking at the moment or currently looking at. And then any rate change adjustments, the effect of rate change adjustments we will look at later. Okay, the next definition is the definition for temporary differences. So these are the differences between the carrying amount of the asset or liability in the SFP and its tax base. So what is the tax base? The tax base is the amount attributed to that asset or liability for tax purposes. Okay, so so these temporary differences result from the difference between the carrying amount and the tax base, and and this will give us then our deferred tax asset or liability. So these are the cumulative, the future temporary differences. Remember, the carrying amount is a promise of the economic benefits that we are going to get in future from this asset, whereas the tax base that we have looked at so far for the asset that we looked at, the plant, the tax base was the future deductions that we could get against these economic benefits from the plant. And that gave us then these cumulative temporary differences, which we had to raise a deferred tax liability for. But we also get temporary differences in our current tax calc. And you might have seen this when you did your homework and you saw that the current tax calc has these little headings. And one of them is temporary differences. So these temporary differences, with regard to, in this example, the adding back the depreciation and deducting the wear and tear, these are the current tax temporary differences. So these are the current tax effect of our these future temporary differences unwinding in our current tax calc. So if we look at the calculation of deferred tax, I showed you that this definition, we start off with all our assets and liabilities from the SFP, and then we put in the carrying amounts, normal accounting carrying amounts, and we compare that to the tax base. And the difference between the two gave us a temporary difference on which we will calculate using our tax rate the deferred tax asset or liability. Okay, so this tax base, the definition in paragraph 5 told us that it's the amount attributed to that asset or liability for tax purposes. So it's like the SARS carrying amount. And then the temporary differences in this column is then this difference between the carrying amount and the tax base. So carrying amount less tax base gives us our temporary differences. Now we get two types of temporary differences. We get the taxable temporary difference and we get deductible temporary differences. So taxable temporary differences are temporary differences that will result in taxable amounts when we determine the taxable profit or tax loss in future periods. Whereas deductible temporary differences will result in amounts that are deductible when we determine the future taxable profit or tax loss. Okay, so if we have a look at the temporary difference that we have over here, do you think that will be a taxable temporary difference or a deductible temporary difference? Yes, you are correct. It will be taxable temporary differences because it's going to, this temporary difference is going to result in taxable amounts in future. So we have our depreciation that we had to add back was less than the wear and tear allowance that we deducted. So we got the benefit in year one. So that benefit in future will swing around and we will have to pay more tax. And so therefore this is a taxable temporary differences because our future economic benefits from this asset will be 630,000. Whereas the amount that we can deduct against these economic benefits for tax purposes is only 600,000. So 30,000 of these economic benefits we will not have any deductions for, so therefore we will be paying more tax. Now, if we look at the example where we adjusted the calculation of depreciation to 25%, so over 4 years instead of using 10%, then we saw that we had a different situation where we actually had to pay more tax in year one, and then overall the cumulative, if we add these amounts from year 2 to year 7, we would get a benefit. So we said that we have to recognize a deferred tax asset for this. So if we put these amounts into our deferred tax calculation, we see that our carrying amount will be 525,000. So that's the original cost of 700,000, less the first year's depreciation at 25% of 175,000. The tax base stays at 600,000 because it's still allowed over 7 years. And now if we do our calculation carrying amount less tax base, it gives us a negative temporary difference. So this negative temporary difference will then give us, if we multiply that to 28%, a deferred tax asset. Okay, so these will then be deductible temporary differences. In future, we are going to have deductions because look at this. The carrying amount is the future economic benefits we are going to get from this plant is 525,000, whereas the deductions is more. We are going to get more deductions than we are going to get economic benefits. So therefore, we are going to be able to have a bigger deduction, which gives us deductible temporary differences and this tax benefit that we recognize now as a deferred tax asset. Okay, so these are then, this is then the deferred tax or deductible temporary difference definition, and we see that this will create a deferred tax asset for us. Now, usually we do not have only one asset. We usually have a lot of different assets as well as liabilities. So our deferred tax calculation, we will list all our assets and liabilities from our SFP and bring in the carrying amounts. Now, it's a good idea to put your liability carrying amounts in brackets. And then when we calculate the tax basis, we keep the signs the same. So the assets tax basis will also be positive amounts, and the liability tax basis will be negative amounts, so that when we do this calc of carrying amount less tax base, it automatically kicks out the correct sign for our temporary differences. Okay, where a positive temporary difference is a taxable temporary difference, giving us a deferred tax liability, and a negative amount here will be a deductible temporary difference, giving us a deferred tax asset. Okay, so when we do this calc over here, remember you have to say minus the carrying amount minus the tax base, and then it will give us the correct answer. Okay, but don't just learn this off by heart. Understand it, feel it, get that warm fuzzy feeling so that you know what you are doing. Okay, now the movement then, we calculate all of these different tax assets or deferred tax assets and deferred tax liabilities. We add it up to get a total, and we know that we want the balance of our deferred tax account to be this amount. So we have an opening balance. Now we calculate what should the adjustment be to get to the closing balance, and this adjustment is then what goes to the SPLOCkie income tax expense. Now, to calculate the tax base up to now has been fairly easy. When we calculated the tax base for the plant, we realized that it's going to be the future wear and tear allowances. However, for some assets and liabilities, it's not that simple. So IAS 12 provides us with some formulas for calculating the tax basis for assets and liabilities. We find these in paragraphs 7 to 11. In paragraph 7 of IAS 12, we find the formula for calculating the tax base of an asset. And when we read this first sentence, you'll see that it sounds very familiar. The tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that we will get, that will flow to the entity when it recovers the carrying amount of the asset. So in future, when we recover the carrying amount of the asset, the taxable economic benefits that we'll get from that, the deductions that we can put off against these taxable economic benefits will be our tax base. However, there's a second section, a second sentence in this paragraph that says, if those economic benefits will not be taxable, then the tax base of the asset will be equal to its carrying amount. Okay, so there will be assets on our SFP which will, when those assets are realized in future, the economic benefits that we will get from realizing these assets will not be taxable. And in that case, then the tax base will be just the same amount as the carrying amount. Okay, so we have to ask ourselves, when we have an asset and we want to determine what the tax base is, we have to ask ourselves first, will the economic benefits be taxable when we realize this asset? So the economic benefits from realizing this asset, will it be taxable? If the answer is yes, then the tax base will be the amount that will be deductible for tax in future. If the answer is no, then the tax base will be equal to the carrying amount. In our deferred tax calc, we know that for the plant, the asset that we've done up to now, we know that these economic benefits that we are going to get in future will be taxable. Therefore, the tax base will be the deductions that we will get against these economic benefits in future, giving us then a taxable temporary difference and a deferred tax liability. But what about other assets? What about inventories and debtors? So for inventories, the carrying amount over here will be realized when we sell these inventories. So when we sell it, we're going to get revenue for the sale, and we will be taxed on this revenue. So therefore, the economic benefits from selling these inventories will be taxable. That means that the tax base will be the amount that will be deductible for tax in future, which will be the cost of sales, the original cost of these inventories. So we're not going to be taxed purely on the gross revenue that we realize from the sale. We will be allowed to deduct the original cost of these inventories, which is the same as for accounting purposes, and therefore it makes sense that the tax base and the carrying amount should be the same, resulting in no temporary differences and no deferred tax, because there's no difference between the accounting and the tax treatment, no timing differences. Okay, now for debtors, if we have this debtors balance of 50,000, when we realize these debtors, so the debtors will be realized by getting cold hard cash when these debtors pay us. So in effect, we will just be swapping one asset being the debtor for another asset being the cold hard cash. When we get that cash, we will not be there's nothing that we can deduct against the cash that we get. So if we follow the normal formula, then our tax base there will be 0, resulting in a temporary taxable difference and a deferred tax liability. Now that does not make sense, and that's the reason. And the reason why it does not make sense is we are not going to be taxed in future when these debtors pay us. We've already been taxed on the day that the sale happened. So there's not going to be any future tax. So therefore, we need the second part of the formula for the tax base of an asset, where if the economic benefits will not be taxable, the tax base and the carrying amount will be the same. Now for the debtors, when we get the economic benefits, when we get the cash, we will not be taxed on it again because we've already been taxed on the transaction when it happened. Therefore, the tax base will be the same as the carrying amount, resulting in no temporary differences and no deferred tax. Now that makes sense. Next, we have the formula for calculating the tax base of a liability. The formula tells us, we find this in paragraph 8, that the tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. However, we get different kinds of liabilities, and that's why we need this second sentence that says, in the case of this liability being revenue received in advance, the tax base will be the carrying amount less any amount of the revenue that will not be taxable in future periods. Because obviously if it's revenue, then there won't be any amounts that will be deductible. Revenue might be taxable. So that's why we need these two different sentences in this paragraph, in this formula for the tax base of a liability. Okay, so normal liabilities, the tax base will be the carrying amount less the amount that will be deductible in future. Whereas for revenue received in advance, which is also a liability, the tax base will be the carrying amount less the amount not taxable in future. So if we have creditors on our statement of financial position, we will add this to our deferred tax calculation. So add the carrying amount in our calculation. Because creditors is a liability, we'll put the amount in brackets. So the definition or the formula for calculating the tax base of a liability is the carrying amount less the amount that will be deductible in future. Now in future, when we pay these creditors, we will not be able to deduct these payments for tax purposes because we've already we were already able to deduct the purchase of whatever it is that we purchased from the creditors on the day that the transaction happened. So when we in future now pay these creditors, there will not be a deduction. So therefore the tax base will be the carrying amount less 0. Nothing will be deductible in future. So that gives us then a 0 temporary difference and a 0 deferred tax, which makes sense. Because there's actually no difference between the accounting and the tax treatment for creditors. For accounting purposes, when we pay this creditor, it's not going to go to our P&L, and for tax purposes, it's not going to affect our taxable income. Now, for income received in advance, we are first going to think about it logically before we apply this formula, so that I can convince you that we do need this separate formula for this type of liability, income received in advance. So let's think about what our current tax calculation will look like if we do have income received in advance. So in year 1, we received some income in advance. So we would have said debit bank, credit, income received in advance. Both are statement of financial position accounts, so nothing will go to my accounting profit. However, for tax purposes, we are going to be taxed on this income received in advance, because we will be taxed on the earlier of accrual or receipt. So for tax purposes, we will have to go and add this income received in advance into our current tax calc, which means that for year 1, we are going to have to pay a tax on an amount that is higher than our accounting profit. Now, what happens in year 2? Now, last year when we received this income in advance, it was actually income that will only accrue in year 2. So that means that that income will be included here in our accounting profit for year 2. We couldn't recognize it as income in year 1, which is why we parked it on our SFP as income received in advance. But then in year 2, we can now show it as income. So because it's included in our accounting profit over here in year 2, we have to now deduct it. Otherwise, if we just leave it in there, we are going to be paying tax on this income in year 1 as well as in year 2. So that's why we have to deduct it in year 2 to get rid of it, so that we are not taxed on it twice. So can you see what's happening here is we are now getting a benefit in year 2 because of this timing difference. And it is just a timing difference. So it's just a difference. For tax purposes, we are taxed on it in year 2, but for accounting, we only show it as income in year we are taxed on it in year 1, but for accounting, we show it as income in year 2. So the net effect is 0. Now, if we apply this to our deferred tax calculation, it means that at the end of year 1, so after year 1, we know that we are going to get, for this income received in advance of 20,000, we know that we actually have a deductible temporary difference, because we know that in next year we are going to be able to deduct this amount again. So we know that we want a temporary difference here, which of a deductible 20,000. So if we now apply this formula that they give us in paragraph 8, which says that the tax base should be the carrying amount less any amount not taxable in future, you will see that we do get to this deductible temporary difference. So our tax base will be the 20,000 carrying amount less amounts that will not be taxable in future. So at the end of year 1, we will not be taxed on that income again, because we've already been taxed on it in year 1. So that's why the amount that will not be taxable in future will again be the full 20,000. So my income received in advance tax base is 0. And if we now do our calculation, minus 20,000 minus 0, it gives us minus 20,000 and a deferred tax asset. Now we also have some items that are not recognized in our SFP, but that will give us some that will have some future tax consequences. And if that is the case, we must remember to also add these items onto our deferred tax calculation. Okay, and the example they give us here is research costs. Okay, so let's just look at that example. So for research costs, like the example that you had in your revision test, we had research expenses that we got an allowance for at 25% per year. So what happens is that for accounting purposes, we expense the total amount. So therefore, there's no asset. We didn't capitalize any of those research expenses. We expensed the full amount. So at the end of year one, the full amount was expensed, no carrying amount. However, the allowance is given to us at 25% per year. So we got the first 25% in the year that we incurred the expenses, but there is a 75% remaining that will be deducted over the next 3 years. Okay, so these are the future deductions then that we are going to get for these research expenses. So if we now do our calc, 0 carrying amount less the 75 future deductions tax base, that gives us then a negative amount in our temporary difference, meaning it's a deductible temporary difference and a deferred tax asset, which makes sense because in future we are going to be able to have these deductions make our accounting profit less to get to our taxable income, whereas for accounting purposes we took the full hit in year one. So over the 4 years, the tax and the accounting treatment is actually the same. However, there's a timing difference. In year one, for accounting purposes, we deduct 100%. For tax purposes, we deduct 25% per year.